Hey guys, Toby Mathis here. Everybody asks me the same question. Should I start with stocks or with real estate? And I usually ask one question right back. Why are you asking now? This is what's always interesting. Almost every time it comes down to this. Somebody they know is making money in one of those buckets. They're either hitting it with the stock exchange or they got, hey, I need to be getting into real estate. This so-and-so is making money. And they feel like they need to jump into it too. It's all of a sudden front of mind. And there's actually a name for it. It's called the Baader-Meinhof phenomenon, also called frequency illusion. And it comes from this German phenomenon that occurred years ago where this small organization, which nobody had ever heard of, all of a sudden they start getting heard about, and then you see them everywhere. And it's the same thing. I'll make it relevant to us. Let's say you're thinking about getting a new car, and let's say you look at an F-150. Suddenly you're going to see them everywhere. They were always there, but your brain just now started paying attention to it because it was not relevant to you before. And the same thing happens in investing. We can use the same phenomenon to open up our brain. And this is how I'm going to start. I'm going to start with stocks. I'm going to say, and there's a number of reasons, and I'll get into those later, but the minute you buy shares in something like Coca-Cola, you will start noticing finances about Coca-Cola. You'll start noticing about it everywhere. All of a sudden, you're going to care about their earnings. You're going to care about things like what's their dividend date. You're going to look at their PE ratio. And for the first time, it actually means something to you. Like I could have tried to have taught you these things before, but it wasn't relevant. It wasn't of interest. But now it is. And why? Because now you have some skin in the game. And this is how competence is actually built. Not by watching 10 more videos, not by reading another thread on Reddit or, talking to all your buddies. It's by owning the thing and paying attention. It actually triggers that part of your brain that says this is now relevant to me. And I've said for years, studies have shown this, that it takes about 20 hours of focus, skin in the game effort to become competent at something. I'm not talking about being an expert. That's like 10,000 hours. But in 20 hours, you can be competent at most everything, including how to invest. And it's enough so that you're not guessing, and it's enough to where you can start being deliberate in what you're doing. And that is exactly why I tell people start with stocks. Not because real estate is bad. I love real estate. But real estate is one of the wealth building tools. It's one of the best ones in the entire tax code. There's huge tax breaks in real estate. But if I buy a single family rental, it can cost me more than what I invested in it, right? This is one of those things. If I buy Coca-Cola shares, the worst thing that can happen to me is I lose the value of that. It goes down in value. But if I buy a property, that tenant can sue me for mold. The roof could collapse on somebody. The tenant can trash the place. They can fail to move out. They can end up being a holdover forever while you are paying for the house, right? It can end up really causing you a nasty financial impact. Stocks give you something that beginners really need. And I'm talking about folks that are just getting going. Like if I'm talking to a young person and they're saying, hey, Toby, where'd you start? I'm starting with stocks, and it gives you a safety net. Let me explain that. I use a framework in the Infinity Investing Allocation model. I wrote a book called Infinity Investing. In fact, I will make it available to you in the show notes. All you got to do is the e-version. You can go buy it on Amazon, but I'll give you as a gift the e-version. All you have to do is go down in comments and type free book, or I'll put the link in there. But if you go and you type free book, I'll send you straight to the link. Otherwise, it's in the show notes. And basically, I've been doing this for close to 30 years. And after reviewing thousands and thousands of tax returns and doing planning with thousands of investors over the last 3 decades, here is what I've found. People who build lasting wealth usually end up building them in 3 buckets. And I use this thing called the 30, 30, 30, 10 rule. That's our infinity investing model. 30% is going to be in income producing stocks, dividend stocks. And we like to make money in so many different ways on stocks. Like I want to get paid to go into them using a cash secured put. I want to own the stock and get paid dividends. I want to be able to sell somebody else the right to buy my stock at a higher price called options, called covered calls. And I want to get paid if I sell the stock. That's, if you're counting, that's 4 ways I'm getting paid on one stock. That's where I'm going to start, but I'm just going to put that over here. I'm just going to call it the stock bucket so you can see it. 30% goes in real estate. So you're saying, Toby, you just bashed on real estate. I said, when you get started, then there's a downside to real estate that we cannot, like it could ruin your life. So I'm always going to tell people, you're going to start in the thing that can do the least amount of damage. Real estate can be absolutely phenomenal if we mitigate that risk. And a lot of times that risk is just our ability to handle a natural side effect of having real estate, which sometimes they need a new roof, sometimes they need AC, sometimes you have a bad tenant. I just don't want it to be your first experience in real estate, so you get smacked. That could be very, very painful if you don't have the cash set aside to handle it. For everybody else, you can manage it, and we'll go over that in a second. So there's 30% that's going into real estate. Then 30%, I'm going to call this managed money. So I'm just going to put MM. And what that means is you're not making the decision on it. You're either hiring somebody who's going to manage your money if you have enough of a portfolio, or if you're just, again, you're just going through the first steps and you're starting to generate. I would say if you're less than $150,000 in investable assets, right? And that's a lot of people out there. When you're doing 50,000, 50,000, 50,000, just for sake of argument, I'm just going to go, it's usually where I start. You're getting into a situation where you're saying, hey, all right, I need to start to decouple my decision making from what's actually going on. So sometimes I'm doing ETFs, sometimes I'm doing managed money, sometimes I am just mirroring a portfolio of somebody else. That's what I call managed money. Also lives in there syndications, also lives in there if I'm doing, hiring somebody to manage. But 30% is there. A lot of people that do it on their own, the do-it-yourselfers, we start off and we get one thing and we're just overweight in that one thing, and then when there's a drawdown like what we had in 2008, housing market gets smashed, stock market lost 38%, you get crushed. I want to spread it out. I want to make sure that I'm not exposed. And then 10%, this is your cash, this is your gold, this is your Bitcoin, this is, I call it cash or cash equivalents. And it actually works. This is great. I have dry powder in case an opportunity just shows up. But that's the model. That's the model that we use. So the real question is not where you end up. The real question is where I start, which I want to start along this direction. And so for most people, when you're getting started, the answer is stocks. And here's why. First thing, liquidity. If you buy a stock today and you need the money 3 months from now, you could sell those stocks. You're done. I can get them 3 days to settle. I got the cash in my account. If you buy a rental property today and you need the money 3 months from now that's an uglier conversation. It's not easy to turn that into cash. Maybe I could borrow against it, but if I have to sell that sucker, it could take months to liquidate that. So liquidity is not a luxury it's not some luxury for beginners. It's actually protection. It's essential. It gives you flexibility. It gives you margin for error. And when you're new, that margin for error really matters. It's not something that I can ignore. Having seen this, again, over and over again, I've seen this where a bad, simple something that should have just been a road bump, but it takes somebody out. It puts them into a panic mode, and panic destroys wealth. So we want that liquidity. Second, the learning curve. And this is where people fool themselves. And they think that real estate is easier because they can touch it. And I love real estate. I am an avid real estate investor. But in the sequence of things, I'm going to start off with stock. But I can see a house. You can understand what a house is. But understanding what a house is and understanding real estate investing are two very different things. Real estate done right means you're looking at the right markets, financing. Do I have reserves? Do I have CapEx put aside? What about my tenants? What about maintenance? Do I have a good property manager? What about insurance? What about that vacancy rate? What's normal? What should I be expecting? What about legal? Hey, what are these LLCs and land trusts? What about cash flow? There are a lot of moving parts. And if you get one of those wrong, it can get pretty expensive fast. And we're going to make mistakes, and we're going to have things like the bad tenant. You just don't want it to take you out. With stocks, man, you learn with smaller mistakes. So let's say I start with stocks, and I'm not gambling. I don't mean to throw money into the stock market. You know, something that your brother-in-law said, hey, this is a great stock, and while you're working out at the gym. No. I mean, you start with quality stocks. You start with boring. You start with companies that have been paying and increasing their dividends for years. I'm talking about decades. Dividend aristocrats, which is 25 years of increasing their dividend. If you don't know what a dividend is, fancy way of saying they pay you the profit rather than keeping it in the company. So if I invested in my uncle's pizza shop, he's not keeping the money, he's paying it back out to me. So the aristocrats are companies that have been paying usually over $1 billion, and they've been increasing their dividends, which means they pay you more and more every year for at least 25 years. And then there's another step above that called the dividend kings. And these kings have been doing it for 50 years. Companies like Coca-Cola, Johnson & Johnson, Procter & Gamble. And then we run them through a filter. And I use a 7-point filter. Really simple, like, this is what I do. I learn little things so that you can be competent at stuff. Does the stock yield more than 2% in dividends? In other words, if I buy a stock for $100, is it paying me at least $2 a year? And is that $2 a year going up so that in 20 years, if I've owned that stock and I bought it for $100, it could be paying me like $10 a year, years from now, and all of a sudden you're like, boy, I bought that really cheap. It's bought itself and paid for itself over and over again. And I have this cash flow coming in. Has it been trending up? Is at least in a stable channel? I don't want to be buying call it don't catch a falling knife. Does it have options? Can I do the covered calls? Can I make multiple streams of income on that one stock? Remember I said there's 4? I want that. Has the dividend been consistent for at least 10 years? Has it been growing? I personally don't like looking at companies when I'm starting and when I'm working with people that are building up their initial little nest egg. I want at least 10 years of increasing their dividend and paying it out. And then we start looking at revenue. Is the revenue stable? Is this a company that's still growing? Is the PE ratio in a reasonable range, say 15 to 25, or are you buying something that's way overblown? And if these numbers, by the way, or these terms, they don't mean anything to you yet, that's why you buy the stock, because all of a sudden it's relevant. And I'm saying, hey, what's the PE ratio of Coca-Cola, right? I also run it through and I say, are analysts more positive? I look at like 3 to 1. So if I have ratings on this thing, do I have people rating it a buy or a strong buy, much more than sell or, get rid of it? If I see a sell, I want to at least say 3 buys. And then if it's neutral, I ignore them. You really want all 7 of those things. I just went through 7 criteria. And by the way, this is what we teach at Infinity. So get the book. Again, type in free book in the comments, and I'll send you a link, or you can go grab the link in the show notes. I want 7 out of 7, or if you're in for a little bit of risk, maybe a 6 out of 7. When we do this, a lot of times we put a rating next to it. There's a couple of organizations that actually do a numerical rating as far as what the risk is. And so we're looking at that too. It's not technically part of our 7 out of 7, but we're rating stuff. We have a nice community at Infinity. You can learn about it when you download the book. And this is because we are not speculating. You are learning. This is why we buy stocks. This is school. And you're learning how to evaluate quality. Because once you own it, everything changes. Now all of a sudden it's relevant. Remember that Beider-Meinhof phenomenon I told you about? Now you're going to learn why we use it and how we use it. It's neuroscience. and we're going to use it to our advantage, because once you own that stock, it just, boom, things change. The earnings reports matters. Now dividend dates matter. The valuation matters. And when you're watching this, these stocks kind of channel around and what they do, you're building some of the pattern recognition. You're seeing how the stocks behaved over the years. And this is the real win in the beginning. Making money is secondary. You're not just trying to make money. You're trying to become the kind of person who understands how money works. And let me make this clear. I'm not anti-real estate, far from it. I love real estate because the tax code loves real estate. It gives you this huge thing, depreciation. It gives you bonus depreciation. You can lever it. It gives you control. It gives you so many different options. But in many cases, you're like in real estate, let's just be real, like you may never pay tax on the appreciation if you plan it correctly. There's 1031 exchanges, there's step up and basis, there's all this stuff, and your family may never pay on it either if you use the step up and basis. We call it the buy, borrow, die strategy. So I just want to be clear. I'm not telling you to avoid real estate. I'm telling you not to start in a way that blows yourself up. And that's what I see all the time. Somebody saves up $20,000, $30,000. They watch a few YouTube videos and they get excited and they go, whoa, I'm going to go and I'm going to buy a cheap rental in a market that I do not understand. And then that tenant stops paying. And the AC dies in the middle of the summer and has to be replaced. And the roof starts leaking and the property taxes jump. And the problem is, it's not with that. Like, again, those are great little houses. You got to own a few of them so they start to average themselves out. But what if that $20,000 to $30,000 you invested was your entire cushion? You have no liquidity, no flexibility, and a property you can't unload it without taking a loss. And that's where beginners get hurt. And I don't want that for you. So if you want exposure to real estate early, but you do not have like a whole bunch of money, like a cash buffer so you can stomach something that, maybe hey, I bought this, I know that the roof's going to be replaced every 27 and a half years on average, right? That's kind of the useful life. Maybe it's going to make it 15 years. What if you buy it and that's the year you got to replace the roof, right? We want to make sure that that doesn't take you out because you don't have deep capital. There's smarter ways to do it. First, I'm going to give you a few that you can get involved in real estate. Like if you are just fixated on real estate and you're saying, Toby, I feel strongly I can do both. What can I do without destroying myself? The first one I would say is house hacking. You buy a single family residence with extra rooms. A lot of people buy duplex or triplex, maybe even a small multifamily that's got 4, 6 units. You live in one unit and you let the other units help cover the mortgage. Usually you're levering yourself into this. Usually this is the house you're buying. And now you're learning landlording and you kind of have the training wheels on. You have skin in the game, but you're not jumping straight into the deep end. And house hacking, by the way, is when you buy a house. Let's say I buy a house with 4 bedrooms and I rent 2 of them out, or I got an extra basement and I rent one out. Known plenty of people that started doing that, and then they just add roommates, and then sometimes then they go buy a second house, they go move in that and do the same thing, and then they're doing what we're calling house hacking. That's actually a great strategy. I've seen a lot of people very successful with it. There's a great company that we talk about inside of Infinity called Pad Split that allows you to do it. It's one of those solutions that could actually help the country, especially if you're living there, because you're helping people, providing them with housing, and it's usually a lot less expensive when they're renting a room than if they go buy, have to go get an apartment. Second, this is one that I've seen a lot of folks do and they've been very successful with. It's the live-in improvement strategy, which is you buy a primary residence that's maybe a little long in the tooth, maybe a little beat up, and you fix it up. And you live in it for at least 2 years, and then you sell it. And why do I say 2 years? Because if you're single, you can exclude up to $250,000 of gain from federal tax. If you are married, you get $500,000 as long as you lived in it 2 of the 5 years. So if you lived in it for 24 months at least, and then you sell it, then you get this big old exclusion. You don't have to pay tax on it. And it's one of the great wealth building breaks in the tax code that's sitting out there. A lot of people use it. They live in a house. And again, the rule is 2 of the last 5 years, and you sell it. If I've lived in it 2 of the last 5 years and I sell it, then I don't have to pay, I have a capital gain exclusion. So if you are living in a house, I buy a house and I fix it up and I sell it every 2 years, I can keep doing that over and over again. You do that a few times over a decade, and you could build some serious capital without ever owning a traditional rental property. I never rented it to anybody. All I did is I bought a kind of a beat up house and then I just fixed it up. Maybe I did it myself on the weekends. Maybe I hired someone to help me, but you've greatly reduced it because you're getting utility out of it. You needed a place to stay anyway. And now all of a sudden you're getting that extra, you're building your equity and then you're selling it and that equity is not taxed. A lot of folks have done very well with that. The third area, and this is the one that kind of fits in this, like if I'm doing this strategy and I'm going right here to here, remember, stocks, I kind of want 50,000 in each one of these as I'm first starting, going this direction. The 10% is all on top. Like I always say, like I got to have a cash buffer. But if I'm building up wealth and I'm just, hey, I'm going to go to the stock market, I'm going to try to get up 50,000 and then I'm going to go to real estate. And you're like, Toby, how am I going to spend $50,000 in real estate? There's no properties for 50 grand. You're right. We use real estate investment trusts. They're called REITs. And it lets you own real estate with the liquidity of a stock. They're publicly traded, they pay out dividends, and they teach you how real estate behaves without trapping your money in one property. And it is a great training ground. If you're willing, again, you buy it, you start learning about it. Federal Realty Trust is a great one. You go in there, what are they buying? What are they doing? And you start reading their finances, and it's going to start, you're going to learn. And that's what's amazing. Because what you do not want is take your first 30 grand and buy some distressed single family house that you in a market that you don't know because somebody online made it sound easy. And by the way, I'm going to just do a little excursion here. I want to talk about something. It was Michael Crichton, the novelist, coined this phrase. It's called gel-man amnesia. Gel-man. And what this is it's a cognitive bias. When I read, I'm a tax guy, and when I read an article in the newspaper about taxes, almost always I'm like, oh, that's too simplified. That's not correct. I'm looking at it. In other words, I know that it's incorrect. It's because I'm an expert in that area. But then I'll go read another article on real estate, and people assume that that is actually accurate. And that's what I'm talking about. When you're reading this stuff online and you're reading this stuff where people promoting this stuff, they might not actually be doing it. Quite often they are just writing, they are not an expert in the area. You need to find some, and by the way, this is an AI too. When I use AI in tax, I can usually tell. I know when AI is hallucinating because I know that area. No, a lot of people don't. And the last thing you want is to get hallucinated information. So you have to look at the numbers. You have to follow a system. And I know I've already said it, you can go get the infinity investing is about cash flow. It's about becoming a landlord and a stock market landlord and looking at things. I want to buy chickens and eat the eggs. I don't want to eat the chickens. In real estate, we do the same thing. The numbers have to work. Let me just give you an example. When I underwrite a rental, when I'm saying whether I want to buy it, I am very conservative. If a property rents for $1,500 a month, I'm not going to pretend like I get to keep it all. So if I get a $1,500 a month loan, where I have a mortgage that I have to make a payment, I'm not going to pretend that I'm keeping the $1,500. I assume that roughly half, at least, is going to disappear in taxes, insurance, maintenance, the management fees. There's going to be vacancies. There's going to be repairs, CapEx. If that $1,500 comes in, maybe $750 is what I'm keeping. That just comes from experience. But I always see all these articles, and they're like, you get $1,500 a month. You are not getting $1,500 a month off of a $1,500 a month rental. You are going to be lucky if you get $750. And then that $750 still has to cover the debt service. And that debt service will have to be below $750 for me to have positive cash flow. If the math does not work, don't do the deal. If the math does not work, I don't do the deal, period. So here's the sequence that I'm going to say. By the way, we'll teach you all this at Infinity if you want. You just free book in the comments. And if you have comments, if you're a real estate guy, go ahead and tell me whether you think I'm all wet or whether you agree, and give suggestions to people. I would say, folks, sometimes on these videos, there's gold in the comments, and go down there and take a look in the comments, because some of these folks with experience will share that experience with you. And they'll say, Toby, actually, this is what I've found. Fantastic, as long as it's somebody who has that experience. But here's the sequence I want you to go through. We went over it before. You start with stocks. And if you're just getting started, you're starting there to build competence. You start learning how money behaves. You use dividend-paying companies as your training ground, and it protects your liquidity. I can get rid of this money or these stocks quickly if I have to. But I am also going to have the money coming in. I could have the covered call income coming in, premiums coming in. If you don't know what that is, it's being a stock market landlord. It's paying somebody the right to buy your stocks at more than what you paid for it. You could build pattern recognition. You can learn how these stocks behave, and you could build your confidence, because once you start recognizing that stuff, you start feeling really good. Then start moving into real estate the smart way. Now, some of you guys, you could do both. You could do the house hacking, the living improvements and stuff, and do stock, but you want to start the smart way. I'm going to say, if I'm doing this sequentially, I'm starting with stocks, and when I go into real estate, barring me doing something with my personal residence or house hacking and doing the, building in my own improvements, I'm going to start with REITs. R-E-I-T. REITs. Real Estate Investment Trust. They're traded just like publicly traded companies. And as your capital grows, you're going to move towards this entire infinity allocation model. So it's 30% dividend paying stocks, 30% real estate, 30% managed money. And always have at least 10% of your money in that cash or cash equivalents. You don't fill your cash bucket up last. You're filling your cash bucket as you go. So if I have $50,000 that I've ended up in stocks, I'm going to have at least $5,000 in cash or cash equivalents on the side. But that's when I'm looking at a larger portfolio. If I look at $1 million portfolio, for example, I'm saying, is there $300,000 in stocks or income producing things like, I like tax-free munis. People always say, you're not making enough. Depends on what your tax bracket is. For me, 4.5% return is the equivalent of a 7% return if it was taxable. So I'm always I actually kind of like bonds and munis in addition to the stocks. But when I'm starting, I'm always going to start with the stocks because I'm learning too. But I'm going to do, if I had $1 million, I'm going to do 300,000 there, 300,000 in real estate or real estate equivalents, $300,000 in managed money. And by the way, some of you guys are going, wait, couldn't you do a syndication that's in an apartment building and in that real estate? Yes, they start to cross over on each other a little bit. I want to be exposed at least 30% to real estate investments. And it could be REITs, it could be owning single families, it could be owning multifamily. And then all I'm doing here on the managed money side is say, hey, listen to somebody else. Mirror somebody else's portfolio. And that is how you build wealth that lasts. You do this right. It's not by chasing what looks hot right now. It's not by copying somebody else's chapter 20 when you're just starting out on chapter 1, right? You got to have these things in sequence. And it's not by putting all of your capital into one move that you do not fully understand. I've watched way too many people blow themselves up trading these crazy option strategies and stuff. They don't understand it. They're $300,000 in before they realize they don't understand it. And they've lost a substantial amount. So if you know somebody who's about to dump their life savings into a property they're not ready for, share this video with them. Just send it and drop your comments below. Tell me where you started. If you've had some success especially, tell me where you started. Was it stocks or real estate? And what you wish you had known sooner. People will read it. I read the comments and I pay attention to what you want me to cover next too, so you could always give that. And if you're not subscribed to this channel, you should be. Every week I put out videos on tax strategy, asset protection, and legal and financial moves that help you keep more of what you earn and what you build. Most people learn this stuff after they make a mistake. We try to get out ahead of it. And I would rather you learn about these things before without having to walk into a post. And by the way, I have 3 free resources for you below in addition to the free book. Number 1, our tax and asset protection workshop, where we walk through some of the strategies we use with real estate investors and business owners. That we put on almost every Saturday. One of our attorneys, our accountants, some of our ex-clients, they teach this stuff. Second, there's a free strategy session with one of our advisors where we're meeting with you and we're going to tailor something to your situation. And the third one is actually joining the Infinity community. Go get the free ebook, but you can also go to the Infinity Investing courses. We do free classes on how to trade in the stock market, how to get started in real estate. All of those are in the show notes and in the descriptions. And if you want to go deeper, if you want to dive in, spend some time on my channel. There's a bunch of videos that'll help you as you're learning. And remember, it's only 20 hours to get to competency. So if you're just getting started, it's a great place to start. Spend some time here and you'll be astonished at just how quickly that learning curve goes up. And you're only 20 hours away from becoming really, really effective as an investor. Good luck.